Well, today's inflation numbers knock back hopes that inflation is peaking, with some noting that the core rate has reversed after 2 months of moving lower. So let's put that to Ross Gerber, President and CEO of Gerber Kawasaki. Ross, thanks so much for being with us. Does today's data mean that inflation is not peaking after all?
No, not at all. In fact, if you look at month over month, inflation was only up 0.1 over last month, and it was zero the month before. So in fact, it's the opposite. Inflation has stopped going up. And when you compare it year over year, it's a lower year over year rate than the last 2 months. I think the disappointment is that expectation was inflation was just going to sort of like collapse in August, which I think was maybe a little bit of a false hope. But inflation is going down in the United States as we speak in real time. We've seen, every sign that the economy is slowing, including real estate, which is basically stopped. So the data is a lagging indicator, and I think investors need to keep that in mind.
Nonetheless, a 75 basis point hike is pretty much certain at next week's FOMC. But what of the Fed after that? Do you think a pivot is on the cards at some point fairly soon?
Yeah, see, we look at it as the Fed doesn't matter. The market has already moved. The Fed is actually just super behind, and that's been the cause of all this uncertainty, unrest in the markets. And so right now, if I buy US Treasury bonds that are, let's say, a year out, I'm already getting well over 3%, but yet the Fed funds rate's at 2.25. So actually, I can get yields close to 3.5 on short-term US Treasuries right now. So the Fed raising 75 basis points only gets them to 3%, and the market's telling them that they need to get to 3.5%. That's what the market is saying. So I don't think anybody should be worried about that. That's where the Fed is going because that's where the market is. And so I think it's just this catch-up game the Fed is playing, and everybody's worried about stuff that's a month or two old. But really, what we're seeing into the future is that the economy is definitely slowing, and the effects of the Feds are happening, and inflation is dropping. So it's going to take a few more months to really see all that come out, but it's happening.
Okay, well, you say in your notes to us, in fact, that we need more data so that the Fed doesn't, quote, destroy the economy. What are you particularly looking out for, and what does it mean for stocks?
Well, what we're most concerned about is real estate. Real estate is the biggest driver of the economy across all, countries, whether it's commercial or residential. And with higher rates, it directly affects real estate, which then directly trickles down through the entire economy and commodities. And so what's happened here in the United States with mortgages soaring, the rate soaring, is the real estate market's just stopped. In a lot of markets, pricing is already going down. And, this is a real big, slowdown thing on the U.S. economy. So I think that's what investors really need to pay attention to is the real estate market. And what we're seeing right now is that the Fed's actions are working and the Fed needs to be very careful, but we're going to see much weaker data coming in over the next 3 to 6 months. And then the Fed will have to adjust its tone as the data comes out.
Okay, Ross, we'll leave it there. Ross Gerber, President and CEO of Gerber Kawasaki. Thank you today for those insights.